so that these shocks will be easier to manage. And whether we should go to the extremes of the market, again, it's a different conversation. Well, this is the outcome of the last MPC meeting. You can see monetary policy rate at, MPR 27.225, cash reserve ratio 50% for liquidity ratio, and arithmetic corridor at plus 500 basis points and minus 100 basis points around the MPR. Now, implications of tight monetary policy. We are in a tight monetary policy mode now, as you all know. High interest rates, treasury bill rate is high, the coupon on FD bonds is high, good return on fixed income. So a lot of investment are now flocking into all these areas, to these financial instruments. And most of these things, they don't create jobs. Although people are making a lot of money from it. But is that the kind of investment that can lift up the economy in terms of job creation, in terms of alleviating poverty, and all of that? So if those in the real sector now have to compete with this, and these are almost risk-free investments. So how can the real sector investors now compete in this environment to source for fund? You know what it is now, even if you are issuing a commercial paper. The other day I was hearing one of these top companies issuing commercial paper at 29%. How many businesses can survive that? So the reform, in a way, has significantly penalized the real sector of the economy. And that is why we need to have a way to mitigate this. Deceleration, well, this is development finance. Of course, we have DFIs and all of that, but the current dispensation is not so aggressive as far as, or not so bullish on development finance. And development finance exists to correct market failure. Because if you leave the whole system to the market, the real sector will not be able to survive. So in order to correct that market failure, you now have the development finance, and that is why you have some of these intervention funds. Of course, there was a lot of abuse, but we need the development finance window to be able to support the real economy, and we need to expand it, and commit more resources to it. Now, risks to monetary policy effectiveness. Some of our monetary policy positions are based on assumptions that are not quite valid. And the assumption is that if you increase interest rates, it will reduce demand and bring down inflation. That is the basic assumption. But do we have the financial structure to support that assumption? So that is why the monetary policy transmission to achieve some of these economic policy objectives have been extremely limited. Because how many people are borrowing money? Unlike what you have in many other economies where almost 90% of them use credit to buy practically everything, including mortgage. But here, if you want to build a house, you have to struggle on your own. Otherwise, can you go and build a house now and take a loan at 25% or 30%? At the end of the day, you will lose the house to the financier. Because it doesn't just make sense. And these are some of the things that are dragging the economy. Unlike what you have. I mean, when you talk of mortgage in a place like America, it's very critical to their economy. And it's driven by their financial system. But here you have to raise the money on your own. So just to demonstrate the weakness in terms of linkages in our financial system and the limitations to monetary policy effectiveness. Domestic credit to private sector as percentage of GDP. This is one good measure. In Nigeria, at least the last calculation I did for the current, as at 2023, was 26.7%. In UK, it's 121%. In United States, it's 195%. In South Africa, it's 92.2%. In Japan, it's 120.7%. You can see the penetration of the financial system to their economy and the relativity of it. So when interest rates is changing either in UK or United States, it affects their demand. And that they may use that to deal with inflation. But in Nigeria, you can't achieve the same results because the penetration is low. Consumer credit as percentage of GDP, because it's also consumer purchases that also drive up inflation or reduces inflation, if you can influence it. Canada, 102%, UK, 83%, USA, 74%, France, 66%, South Africa, 40%, Morocco, 30%, Kenya, 10%, Nigeria, 3%. And if you look at the consumer credit space now, it's just, I mean, if you are not a salary earner, okay, 5 minutes more, okay. If you are not a salary earner or something, you can't get the consumer, even the one that the president is announcing. Because, again, there are issues of managing the risk of consumer credit. So you must be on a payroll of some people or something. But again, that is the transmission mechanism. That is the assumption on which tightening of monetary policy is based to be able to reduce inflation. These are the risks to monetary policy effectiveness: elevated fiscal deficit. Fiscal deficit was 7.6% as at August 2024, as against a budget target of 3.8%. This cannot make it easy to tame inflation. If you are tightening monetary policy, the people you are penalizing are the corporates that have taken facility from the bank. That is the issue. Reflection of a widening gap between spending and revenue. Yes, we have reports that a lot of revenue is coming in as a result of the reform, but fiscal deficit is growing. So that is another paradox. Low domestic credit to private sector, weak consumer credit penetration, and structural issues. These are the things actually fueling inflation. In concept of inflation targeting, well, is to use, that is the policy of the current CBN. Use your instruments to bring down inflation. And the target for inflation is 21. Multimedia, please. Or is it that my time is up? Okay, 21%, 21.4%, and current inflation is 32.7%. We don't know what will happen at the next MPC meeting. Because if this gap is this much, they may still further increase the interest rates. And the IMF has said that they should continue on this trajectory. They should stay the course. Even when the World Bank person said it at the Nigeria Economic Summit, people also screamed that we should stay the course for the next 15 years. Okay? So that is it. Let me just rush now. Domestic credit to private sector, I think I've mentioned this. Market failure in the financial sector. Market failures occur when markets fail to deliver the desired outcomes or impacting negatively on economic performance. So this conceptual understanding is critical to guide policy choices in economic management. So if you are saying that you are running a market economy, we need to study areas where market is failing to deliver outcomes. And we use that to shape government intervention in the economy. That is the whole essence of identifying market failures. You know? Well, I think I've mentioned that my time is actually up. I don't want to be penalized for overstaying. Market failures in the, these are some of the issues. These are some of the reasons for market failure. misalignment between private rewards and social returns, market imperfections, information asymmetry, externalities. These are intervention imperatives to correct market failure in the economy. Prudential provisions, tenor mismatch, agency problem, excessive risk-taking, development finance we do to support the risk sector, full insurance cover for deposits, and so on. Multi-policy implication for treasury strategy, I will round up now. What is happening? Okay. Treasury management is the interface between the business and its financial. It's key element of financial strategy. Every organization faces treasury issues, even if it does not have a treasury department. Managing these risks, these are risks that are very critical for us as treasury managers, extremely very critical. And we should have our framework, our strategy to be able to deal with it. Foreign exchange risk, interest rate risk, inflation risk, and regulatory risk. Now we are having bank recapitalization. What risk does it portend for us? Because we have seen capitalization in the past, we saw the effects. I don't know how this will turn out, but we should watch out for it. Key issues in treasury strategy, choice of assets to invest in, risk management, and how do we raise money? Of course, these are the critical functions which you know even more than myself. You know, these are choices of assets to invest in. You look at the current dynamics and you make the best decision as to where you should invest your money. Where do you raise the money from? Is it equity? Is it debt in this environment? Or is it a blend of those things? Key considerations, you look at the risk, you look at the return, and you look at implications of servicing debt, implications for the cash flow of the organization. Risk management, this is also a very critical function for us as treasury managers. My time is up, so this is also about risk management, what we need to do. Risk management. The silver lining in the current economic crisis, well, the thing is that there is a very big opportunity for import substitution now. Anybody who is doing import substitution, where the local content is high, that is where we should be. This is not the time to have huge exposure to foreign exchange or imports as much as we can. So there are a lot of opportunities in import substitution, a lot of opportunities in agriculture, for the farmers. If we are not impacted by all this insecurity, it's good business because the prices of farm produce have gone up. And as a farmer, you don't use too much of foreign exchange, and you are benefiting from the high prices that have been generated because of the reforms. So, silver lining, opportunities in exports. Even businesses whose core business are not in exports are now doing exports because of the attractiveness of it. A lot of money comes in. By the time you convert $1 million to naira, you are talking of over a billion naira. That's a lot. So there's a lot of opportunities now in the export environment. These are some of the, we have the regulation of the downstream, more opportunities now in the downstream sector, opportunities in renewable energy. You have the problem of this band A, you have problem of high price of diesel. So renewable energy now is presenting a new opportunity, CNG and LPG, because there's a lot of people now transiting from the regular energy solutions to. Okay, thank you very much. Apologies if I've exceeded my time. Thank you very much.
Thank you very much. That is Dr. Muda Yusuf. A round of applause for him, please, once more, ladies and gentlemen. Well, we would have to take a tea break. Dr. Yusuf, when we are back from our tea break, sir, we would take a question and answer segment for this keynote address. It's always interesting to listen to Dr. Yusuf speak, as he has every bit covered. So, ladies and gentlemen, before we go on our tea break, I just want to do something very quickly. Treasury 360. I'm telling you that it's people on this side of the hall that are alert. Treasury 360. Thank you very much. Now, I noticed that we have a fuller hall, which means that a couple of people walked in much after. Now, we have a rallying call